Hey guys, to our webinar attendees, we're going to go ahead and get started. I really appreciate all of you being here today to continue to learn even deeper about the better alternative to health insurance, health sharing. Your curiosity to find a better way and your willingness to learn and just your frustrations of premium increases being completely out of your control are all reasons you're joining us here today. Today we're going to be uncovering how to take back control financially of more things than you could ever imagine. And in most cases, health sharing and health insurance costs are really and truly just the very tip of the iceberg. It's time to finally uncover even more. Today's hosts and your primary educators, Russ Morgan and Joey Murray, are industry leaders who are committed to finding, studying, and becoming experts in better alternatives to traditional thinking. If they're not teaching at cash flow, mastermind groups, or wealth summits, Joey and Russ can be found challenging their clients' thinking in all things cash flow. And in return, have gotten the names trusted cash flow strategists, brilliant innovative minds, and just really the idea guys. Joey and Russ, welcome to the webinar. We've got a full webinar today, and I want you to tell us a little bit more about this idea of financial control.
Well, let me ask you a question. Have you ever hydroplaned or slid on ice before, Joey?
Yeah.
It's a pretty helpless feeling, isn't it?
Oh, yeah.
When I was in high school, let's just say just a couple of years ago, a friend of mine and I were driving home, and we got caught in a snowstorm. Now, we were totally unprepared to be driving in those conditions. His little two-door hatchback car, after making one wrong move, was doing a 360-degree turn on the highway that we're in. And thankfully, my friend and I walked away from that accident, but his car was a little worse for the wear. Here's what I want to tell you is that we were out of control in that situation, and we've been talking about how in our finances we can be out of control. And I want to prepare you for ways that you can gain back that control. The last time we were talking, Joe, we were talking about health insurance cost, right?
That's right. Mm-hmm.
And we identified health sharing as what we said it was the tip of the iceberg of the things that were monies that were leaving our pockets, not to be pulled back into our family's assets. And we know that there's lots of more areas that are monies that are out of our control.
That's right. I mean, most of our clients are dealing with how they pay their mortgage. They don't realize in some cases how that could be hurting them or helping them. They're putting money in qualified plans or taxes for that matter. That's a huge cash flow that our clients are getting hit with and wondering. They're out of control, but they don't know the answer of how to get those dollars back into their control.
Yeah. Well, today, I would think the tools that you're going to pick up from listening to this webinar is going to be how do we take back control? How do we actually have a place we can put our money and now use it for our benefits? And let's speak back to health sharing, because that's where we were been talking about, and I think that's a good place to talk about where would we put those funds.
Right. Yeah, so I think the natural question we've been getting over and over from people as a result of these webinars is, okay, I'm used to having to save money for my medical expenses with these high deductible plans in a health savings account, or an HSA as most people call it. Unfortunately, that's not where we're going to be able to put the money with health sharing. So, but we don't want to give up. Well, let me ask you this, Russ. I mean, what are the reasons you're getting why people want to put money in the health savings account?
Well, I think most of the time people are saying, well, that was a tax advantage place for me to put money. It was a way for me to save money for the specific need of health care costs, and also there were some tax benefits I got from it.
That's right. So the same, as I mentioned, the same people that are struggling with these super high insurance premiums are also the ones that are saying there's got to be some ways I can save on taxes. So ultimately, we're kind of designing this and saying, what options do we have where we can maintain a tax-advantaged account? If we can go ahead and do that, that's going to give us more of what we want our money to do, right? So we want it to be tax-advantaged, but there's other characteristics that we have to make sure in place in order for us to be able to save efficiently for these medical costs, right? The first one that comes to mind outside of being tax-advantaged would be it has to be safe. Our clients are not looking for a place where, hey, if I put money there today and something happens in the stock market outside of my control, I can show up the next day and it's less than what I put in. That doesn't really bode well when you're saving for something like medical expenses. So it's got to be safe. And then I think the last thing most important is just it has to be liquid, right? If those medical needs arise, we have to be able to get our hands on the money and without penalty, right? So if we're kind of summing it up, those are the three things that ideally we'd want in place for us to be able to put money there.
Well, I think there's a lot of places we can put money. And, you and I have been in the financial world for quite a while collectively, and these are just a few of the places that people do save and invest money. And as you mentioned a second ago, I think it's important that if we are going to have to save money, and we know that because that's the hurdle, we know we've got to save money for future healthcare costs, and in addition to all sort of other things, we've got to have that money be safe.
That's right.
That money needs to be able to be there when we need it
and not lose value.
Yeah, we can't take the risk, because if we're going to have that expense, we can't afford for it not to be there because it's down 20% or 40%. Right?
Exactly.
So there's a few of these things that are not going to apply to that. So if I kind of look at this and I'm saying, okay, we're trying to make the money be safe, right? Well, then that's going to eliminate things like stocks. That's going to eliminate timber. That's going to eliminate real estate. That's going to eliminate gold and bonds. And really, what are we left with?
Right. So we've got savings, CDs, and whole life insurance.
Okay. Well, will those be liquid?
Yeah, exactly. All three of those would meet that objective.
Okay, perfect. Well, that's part of our criteria.
Right.
Because one second ago we were talking about we wanted our account to have some tax advantages, because that was really the reason why we were using the health savings accounts, is that they were giving us some benefits.
Right.
And I think really the benefits that people are trying to get are tax-free, right? I mean, it's not just because we can have 401ks and SEP IRAs and other things that can give us some tax deferral, but I think what we're really after, isn't it tax-free?
Absolutely, yeah. Sometimes it's hard to get somebody to verbalize that, but if we really take the variable out of what our tax calculation is, and we know it's going to be tax-free when we need it, we don't have to wonder about that.
Okay, well then that's going to eliminate some things. So that's going to eliminate our 401ks, our annuities, our SEP IRAs, and our traditional IRAs. And all that's going to leave us with is a Roth IRA and a specially designed life insurance contract.
That's right.
All right, so it sounds like what we need to do here to help people understand how these two work is really just go through some of the nuts and bolts.
That's right. Yeah, let's start with, so option number one, we go into a Roth IRA. So some people know a little bit about those, but I think it's helpful to kind of visualize and illustrate exactly, if I'm going to save money here, how can I do that for these medical expenses, and how does it work from there?
Well, so with the Roth IRA, we go back to what are the criteria that we're going for? We're going for the account to be safe and liquid, right? That's a mandatory situation for us. And there's only certain things that we can put in that wrapper. So the Roth IRA is really just the account and the way it's looked upon by the government. So we can put in a Roth IRA, we could have savings accounts and CDs. You can't put whole life insurance within a Roth IRA, right? So I'm going to go ahead and write in here, we can have savings and CDs. There's obviously lots of things you can put in a Roth IRA, but we've already identified these are the only two that are going to be safe, meaning that they're guaranteed that we could access the money and we could avoid
lose value.
Yeah, we're not going to avoid losing money down the road. So if we're looking at this and we're saying, okay, we're going to be putting money into these accounts, then when that need arises, when something happens in the future and we want to access the money and take it out, then now we can take money out of these CDs and savings accounts within our Roth IRA through the form of a withdrawal, right?
That's right.
And so we would just, what is it that we would do? If we needed the money, we would just call our financial institution and just let them know, hey, I need to access, $2,000, $10,000, whatever the amount is.
That's right.
Now, there's a couple of little points we need to make here. When we're dealing with the Roth IRA, any of the money that's growing, so the return on our money, any of those dollars we take out during this time frame, there are going to be some restrictions. There's going to be some penalties here, right?
That's right. If it's below or if it's before we turn 59 and a half, we're going to have penalties and taxes on just the growth portion. So really we're limited to the principal that we put in terms of being accessible to us for these medical expenses.
So it's important to know, though, you can use a Roth IRA to do these things. You can take out what you've put in it. But like Joey said, if you're taking the money out prior to 59 and a half, then you would be subject to any 10% penalty on that growth of the money and taxation on that. But we can still get the money out, and there's some benefits.
But then there's a couple other limitations that just the fine print disclaimer here, we want to make sure people understand. So what are those, Russ?
Well, we have limits based upon our income. So depending on if we're single or if we're married, there's a limit of about $117,000 a year if we're single, to where we could actually contribute to these plans, and I think it's $184,000 currently if we're married, to how much income we can actually make in a given year and still be able to contribute to this. Then there's some other limitations. There's $5,500 a year that you can put in up to 55, and then if you're over the age of 55, then you can actually put in an additional $500, so you can put in $6,000 a year. So just a few little things to note as far as when we're trying to put money into these accounts. We need to know kind of just some of the limitations of what we have.
That's right. All right, so that's kind of a quick understanding of the Roth. What about, so a lot of people are probably asking the question, especially designed life insurance contract. So explain that.
Well, it's important to know, as you and I have taken the time to educate ourselves on all these different things that exist out there, is that you and I actually went through a certification. It's called the Infinite Banking Concept Certification. The Nelson Nash Institute is the most prominent of those, where we actually did a lot of due diligence over a long period of time in order to understand how to properly structure it. Because when we say life insurance, a lot of people, when you consider life insurance, you're thinking about one thing, and that's what?
Death benefit or protection.
Yeah, protection, the death benefit that's associated with that. And when we're talking about specially designed life insurance contracts, obviously we're specifically talking about accounts that are safe and liquid. So we're only talking about whole life here. We're not talking about, there's all sorts of forms of life insurance, but whole life is the one that's guaranteed by the insurance company to actually grow over time. There's none of the other ones. They all have some sort of variable measure, which goes back to what we said we're not looking for. We can't afford for it not to be there when we need it.
That's right.
Well, for us to actually specially design these things, we want to create one that's focused on what?
Cash value and accumulation.
Sure. Well, Joey, 99% of all the policies bought actually are focused on death benefit. If we're going to specially design one, we want to create it in a way that's not going to be subject to taxation from the government. That actually exists. There's some ways to do that. But then also we can actually design it so we can create the cash to be there when we need it. Because when we're talking about saving money for future expenses, we need to have the money there. So it's important that our policy is not just designed for the death benefit, it's actually designed for the cash form.
That's right.
Well, for us to kind of look through these, I mean, there's lots of details here, and I would tell you guys, if you're really interested in understanding these, we're going to get deeper in this, but for what we're talking about now, make sure you understand that if you're going to use a life insurance policy for these sort of needs, it needs to be properly structured. You need to make sure you're using someone who we would say is authorized and kind of educated through this process. And you can go, actually, Nelson Nash's website is a really good resource in addition to ours that we always forward people to, and it's infinitebanking.org. And on that site, you actually can look up who are authorized practitioners as it relates to this. But yeah, so like we said, we really want to be focusing not on the death benefit portion, but more toward the cash.
Yeah, and so I think at this point, people have questions about these things. It's very common. We actually wanted to invite Don on the call with us today to share with us more about his personal testimony, his personal experience with this process. So, Don, are you on?
Yes, hello, good afternoon. I'm on.
Hey, Don. Can you just share a little bit about your experience with this?
Yes, I've been involved with it for several years now, and my experience has taken the form of two different approaches. One, I can call your office, which has always been a great source of support for me. I can call your office and just ask to gain access to my funds, and it just happens. You know, what you guys do is very efficient and has always been a good service for me. But I think for our listeners today, I'd like to communicate also that I have on several occasions gone and done the work that your office does on my own. So it's a very simple process to gain access to my cash. And when I call the representative of the insurance company and ask for the loan, I can be online and verify that what they see and what I see as available in terms of loan, it's the same. And the first, there's only a couple of questions that they ask me. They want to know how much do I want, and both of us have access to that the limit that's in the account at the time of the request. And the second question is, when do you want it? No forms, no 3-day waiting period, no hassle. It's almost as easy as falling out of bed. Two questions: how much, and when do you want it? They'll overnight it to me, or they'll put it in the slow box and ship it to me whenever the mail ships. I guess there's a third option too. I can have it direct deposited as well. So, which in the case of larger sums in today's banking system, it may behoove it's advantageous for me to do that, so I can cut down on some of that verification phase that banks put large deposits through just to verify that funds exist. So it's very, very easy to do, and I've had very great success in it. And being the father of 4 children that are early 20s down to 14, I bought a lot of cars, and that's where I grabbed my money for those purchases, and it makes it an easy transaction. I've got the cash in my hand rather quickly, and I can make that transaction without much hassle at all, any hassle at all really. And in terms of the health savings account, I see how that would work as well, just as easily. Whatever the transaction is, and I need that funding, it's a quick source, it's an easy source, and you've got multiple ways. I can use your office, or I can make the call on my own. If I'm need to do that, I have that access as well. So that's been a great experience for me, and I'd be glad to answer any questions if anyone has any.
Well, Don, we do have some questions coming in, and you mentioned briefly like when a need arose. Like, would you mind just from when you called to get the money, how long did it take? Just on average, I know you've done it several times, but on average, how long did it take before the money actually ended up in your account?
Yeah, and that's I can get the check in my hands overnighted in a FedEx envelope. So slow boat, 3 days. I can have the cash in the mailbox. And the latest approach has been, which I think is most effective, is making the arrangement so that the insurance company is providing the funds directly to the bank to cut down on large deposits verification process. And that's usually within a couple of days. 3 days is when the funds hit the account. I think they transmit them the next day, and then the bank does whatever they do electronically to transfer those funds from the insurance company to my bank account. So we're talking less than 3 days.
Hey Don, it's Will here. I've got a common question that's asked. You mentioned taking a loan from this account. How did that process work? Did you have to fill out a lot of forms? Were you required to be approved for this loan? Like how in control were you with that process?
I felt like I was in complete control. I've got I think there was one form that I've got a couple of different accounts, a couple of different policies where the process is a little different from each one, but usually there's a form that verifies how you want the funds transitioned or transferred, and a signature line on it, and a quick email transmits the data that's required in order to establish that. I have had some loans from some institutions where I don't recall any paperwork. They've already got me on file and ready to go. So I may have. That's been my experience. Does that answer your question?
No, that's great. We got one last question for you right now, and we may get you to hold on in case we have some more coming in as we finish. But one question we have is the loan versus a withdrawal, and the person is asking, why would you take a loan? Because a loan seems like something you have to pay back or whatever. Seems like a negative thing. Why would you take a loan versus just taking a withdrawal out of the account?
Well, that's a great question. The loan, I have to remind myself of this, and I think our listeners need to be aware of it as well. The loan is using my money in the account as collateral, and that's a huge benefit for us because I'm borrowing. I'm using my money for collateral. I can use my money, and at the same time, it's still growing in the account. And when you start looking at this banking system of ours over the course of time, the value of that becomes extraordinary. Where you're putting your money to work in two different ways. A, you're funding your health care needs, per the conversation today, or in my case, you're buying another used car for your family, for transportation. And at the same time, the money keeps churning in the background, doing what this whole plan is designed to do. So withdrawing cash is really cutting my throat. It's cutting our throats when we do that. It's not a bad thing, but as we've talked about so many times before, there's three ways to buy. You can either save your money and purchase, which gives you I may be going too far on this, Russ, but without a diagram to see it, but you can either save up your money and then spend it all so that you pay cash for things, or you can borrow money and end up paying it back over time. The third way is the way we choose to do it, where we use our money for collateral to buy the things, purchase the things that we need for life and living, and at the same time, because the loan is basically collateralized, or it's a collateral. We're using our cash to collateralize the loan. Our money continues to grow at the same as it always has. And with regard to the issue of paying back the loan, that's a requirement if we're going to make this thing work the way it ought to. we've got to pay ourselves back. And I frankly like paying myself back and paying myself first over other vendors. So I'm glad to put myself at the top of the list in the payback, and it only frees up cash that I can borrow again for things that I know are coming down life's pike. So that's my perspective on why we would take a loan versus just withdraw the cash.
Don, that is great, man. Thank you for sharing that. And I think, you mentioned wanting to have a diagram, and I think we may be able to help you out with that. So what you're really referring to when you're talking about collateralizing that is really opportunity cost, right? And most people don't think about this, but we want to share just a real quick picture. If money is constantly growing on our behalf, it kind of looks like this, like it's constantly moving up, and then it has that little hockey stick there at the end that we all like to see. Now, just a quick comparison, when we're talking about the Roth IRA or savings vehicle of any sort, it kind of looks like this. When we start saving that money, it looks a little bit like this. We're just stacking it up. We've identified some cash that we've got now. It's stacking up over time. And then our only option, as you mentioned before, is to remove that money from that account and stop that curve. And then we have to start over again, right? So these are the only options when we're talking about a Roth or a savings vehicle of some sort that doesn't allow us that collateralization process, as you mentioned. Now, as we're doing this, and maybe not everybody can see this, but hopefully you can, is the opportunity cost getting clearer to you between as we're adding that money up and what it could have been earning over that time frame, and really over our lifetime. So now compare that or contrast that with what you just mentioned, allows us in the life insurance, is that there's other options. We can withdraw the funds like we would in a Roth, but the other option that the insurance company allows us to do is to collateralize those dollars and to borrow against them, which allows, as you mentioned, my money, our money, continue to grow on that curve as we then pay it back, as we're getting checks back from the other members of our health sharing organization. They're actually helping us to reimburse that over time to the insurance company, and we stay on the curve with our money as it relates to that opportunity cost that we were talking about. Now, even when we show this to people, people are like, wow, that looks great, but how does that practically work? Like, how and why would the insurance company allow you to do that instead of just having to withdraw it all the time? And so there's another picture I want to share with you. So the first one is two circles here. There's a policy. Your policy would be on the left, and this is where your cash value resides. And on the right is the insurance company, and this is just how they view our money and their money. They're separate in their view, and so when we need to borrow money against our cash value, we're actually borrowing it from the insurance company. So that money comes to you and allows your money to continue to grow. Now, you can use that money for whatever purpose. As you mentioned, nobody asked any questions about the purpose of it or whether you qualify for it. They just send you the money. You use it for that medical expense, or you even mentioned using it for cars, and our clients use it for innumerable expenses and things of that nature, or investments for that matter. Now, you can then pay back the insurance company. We're just going to use the medical expense as an example. As you're reimbursed, you repay the insurance company, but the whole time, your money in your policy continues to grow uninterrupted. And isn't that what we're talking about, is how to maintain our money on that curve and to allow it to keep growing? So I hope that this picture, or these pictures, will help to explain a little bit about what's going on that allows this vehicle to give you more options as it relates to the efficiency of your money.
Well, Joey, you made some great points there of some of the things, we already mentioned There's lots of things that we're looking for within these specially designed insurance contracts. And the first and foremost is we wanted to have the money to be liquid to us. In order for us to use the money for medical expenses or any other emergency that may come up. Don, you mentioned cars, and we all relate to that because we all use money for cars. And we know that the money needs to be safe, because if we're going to save for anything, the money has to be there when we need it. And then we talked about tax advantages. It's important that we can access money without having to worry about, the government taking 20, 30, 40, 50% out of our pocket. But what you just demonstrated, Joey, is some of these extra things that are like uninterrupted growth, right? You've got money that is actually able to continue to grow for you, even though you're able to use it in addition. We talked about before that they are life insurance, so they're going to have other benefits. Death benefit is just one of those that comes along with it. But our HSA and Roths and other things, they don't provide these little things. They don't provide some of the things like we were talking about before, like disability protection. There's some disability benefits we could have within these life insurance contracts if we set those up with the riders. They also can have creditor protection, can help us if we own a business and are worried about what may happen, and can somebody access our money that we're saving for this future emergency or need. And then if we're older, maybe a long-term care benefit actually can be set up as a rider along with the disability benefits within these policies. And I could keep going on and on and on. But really, I think the major key is that we have options. We have options to take loans, and we have options to withdraw, and we're not limited. And as Don, you were saying, the benefits are much greater on our behalf if we're using this money to find ways to grow our money.
Yeah, so I think undoubtedly what happens when we start sharing this information is the next question is, okay, Joey, Russ, sounds great, almost too good to be true. What's the catch, right? I get this question all the time, and especially, let's even revert back before we get to that, is when we started sharing about health sharing, guess what? The same question came up. This sounds too good to be true. Why isn't everybody doing this? What's the catch on this health sharing thing? And really, it was just a matter of people changing their paradigm, like thinking differently, that allowed us to have this new solution. So the same is true as it relates to setting up these life insurance contracts. There's really 4 things. So the first would be, don't be afraid to think long range. If you are not willing or able or capable to think long range, do not do this. This is not for you. This is not a, hey, year or two, I'm going to try this and see if it works. It's literally, this is a plan that really encompasses your whole life. I mean, and really, don't we owe it to ourselves and our families that we have a plan that doesn't stop at certain points in life? It does self-complete.
Well, I think when you're thinking about, as we're talking about health insurance and saving for health insurance needs, will we not have those medical needs or the need to save money for our whole life?
Absolutely.
And I think us having plans that match and mirror what our problem that we're trying to solve is really important, because some things we could put money in may not be around in 10 or 20 or 30 years, or the plans may change based upon different rules the government has.
That's right.
So I do find it very beneficial in my family's need to be able to have access to it this way.
Absolutely. So second thing, if you don't save money, this doesn't work. If you spend more than you make, and actually here's a newsflash, this doesn't work, and neither does any other financial plan. If you cannot kind of get control of your daily or monthly spending habits and allow that money to work on your behalf. So if you spend more than you make, this is not for you, and we're okay with that. The third thing would be, that pig needs a little tail, by the way.
I'm not the best drawer, sorry.
The third thing would be, it is an insurance policy, so you do have to have somebody that's insurable, whether it's you or someone you have an insurable interest in who is healthy enough to be qualified. It does take somebody to be insured, and so we, of course, can work with you to identify that and make sure you've efficiently set it up properly. And then the last thing we've already talked about, but if you're not working with somebody that understands these and can properly set them up from day one, you're really not only doing yourself a disservice, it could really just not work out well for you at all. So those would be the reasons why this wouldn't work.
Well, I think, if we go back to where we started, and we've gone through lots of stuff over the last couple webinars, and we've touched on, like you said the other day, we touched on the tip of the iceberg with healthcare cost and identifying how health sharing is really the answer to that. But still, we needed a place to save it. And what we've talked about today, I think, is a real benefit to people if they truly, like you said, take the time and understand how these accounts can benefit them as a savings place for their money that can be used for other things, as Don said, but most importantly, it's liquid and it's safe. They're not worried about it going down in value. But there's all these other things, Joey. There's mortgages, there's business expenses, there's qualified plans, taxes, investments.
Yeah, even as people invest in, let's say, real estate or businesses that they're trying to buy or whatever it might be, even those can be a way that people are just allowing money to leak out of their control.
Well, control is what I think you hit the nail on the head. If you're watching this and you realize there's probably some areas that are lying below the surface that you don't understand and that you want to figure out ways to take control over those, here's how you can. I want you to click the link and take a time. What will happen is somebody from our team will get in touch with you and they'll schedule a 30-minute free consultation for us to go through and discuss those areas and figure out if we can help you or not.
Thank you guys so much for joining us today.